When you look at Ray Dalio saying 25% of a recession, possibly this year, I mean, is that far-fetched or is it likely?
No, I would say that the probability of a recession by next year is higher than 25%. If you look at the data, we're in a global slowdown. There's already a contraction in manufacturing. The external sector is contracting. The tradable sector is contracting. CapEx is falling because there is an option value of waiting. If you're a firm in the US, in Europe, in Japan, in China, why would you want to build a new factory when there is a risk of a full-scale trade, currency, technology, Cold War, the US and China?
Right?
No, the borrowing costs are cheap, but if you have a risk of a global recession coming from a trade war, you're not doing CapEx. CapEx is down. What has been sustaining the global economy has been domestic sector, services, and consumption. But if the U.S. were to go ahead with these tariffs on the remaining $300 billion of Chinese goods, that's going to hit the U.S. consumer, that's going to slow down consumption, and that could be a trigger of a recession. Because the only thing is holding actually the global economy, U.S. economy, is consumption, given CapEx is sharply down.
Dr. Roubini, you and I spoke before the Great Recession about the idea of a slowdown. You were remarkably prescient. You were prescient during the slowdown, and you've been prescient coming out of the slowdown. And what I've always loved is your belief in the amplitude that we can't see. Are we misjudging the amplitude now of the instabilities that are out there? Are we misjudging the size of any decline that we could see?
I think the markets are still too complacent. There are a whole range of negative supply shocks to the global economy, a trade and currency war between U.S. and China, a technology and Cold War between U.S. and China, the risk of a hard Brexit, even the risk that there may be potentially a war between U.S. and Iran in the Gulf, and that lead to a spike in oil prices. These are all negative supply shock that would reduce growth and increase inflation and put both central banks and fiscal policy in a bind. In the short run, central banks would ease and there'll be a fiscal stimulus, but if you have a permanent supply shock that reduces potential growth, the right response is not easing, is not financing, but actually not accommodating. And therefore, if you accommodate, you're going to get eventually inflation and runaway fiscal deficits and debt accumulation. So I think the markets are complacent. There is a wide range of geopolitical risk, may turn out actually wrong rather than right. And there are supply shocks as opposed to aggregate event shocks like the one that they hit the global economy after the global financial crisis. So the policy response to a permanent supply shock is not easing, accommodating, financing, but rather to accept the fact that there's going to be lower potential growth. If you have Brexit, if you have a trade war between U.S. and China, if there is a tech war and so on. And I think markets are complacent today.
Right, but Nouriel, tell me about the financial side. You were remarkably prescient about the amplitude of the financial shock in 07, 08, and into 09. Within the shadow banking today, the new shadows of 2020, are we misjudging the potential amplitude from, say, negative interest rates as something new and different?
Well, on one side, negative interest rates implied that there is greater risk-taking. However, unlike 10 years ago where the problems were in the banking system and the leverage of the household sector, right now the excesses are in the shadow banking system and in the corporate sector, whether it's leveraged loans or CLOs or high-yield spreads that are too narrow or fallen angels in investment grade. There is a wide range of excesses that have occurred, the build-up of corporate debt. And so far, since short and long rates are low, that's okay. But if there was a risk of a global recession, those credit spreads would widen. We've seen in 2015, in 16, even last year, there can be a seizure of the CLO market, of high-yield market. And if those shocks occur, then that could be a tipping point for the corporate debt. And the next time around, I would say, it'll be a corporate debt crisis. It's going to be a shadow banking financial crisis rather than household and banks.
But what would that look like? So that would be, what, a freezing up of the markets?
Well, initially, it will be a freezing of the markets. Secondly, there'll be a widening of spreads. Then there will be rising default among high-grade, high-yield, CLOs, and you name it. That's going to lead to a credit crunch, and that's going to exacerbate in a situation in which there is protectionism, the risk of trade and currency wars.
So it could be uglier than 08?
I don't know if it's going to be uglier than 08. It depends on whether the situation between U.S. and China, U.S. and Iran, what happens with Brexit. If those shocks occur and then you have a financial shock, it could get as ugly as 08. It could be milder than 08. It depends very much on other economic and political shocks that may hit the global economy.
Nouriel, the exogenous shock we never can see it coming. We can think as hard as we can, and you just never see it coming. What's the exogenous element right now that you worry about? Is it a Pacific Rim issue? Is it something within the populism of Europe? What's that exogenous thing Nouriel Roubini's considering in this September?
Well, the most important thing is that if there will be a full-scale trade, currency, Cold War and tech war between US and China, we'll have a process of deglobalization, of balkanization of global supply chain, starting with tech, of decoupling the US and China, of fragmentation of the global economy. We've now gone through about 30 years plus of greater globalization, and now there are restrictions to trade in goods, in services, in capital, in labor, in technology, in data and information. And I think that that will be a major regime change for the global economy, going from greater integration and globalization to deglobalization and balkanization. I think that's the element that I think people are underestimating. It's a risk ahead of us.